Two people walk into the same dealership on the same afternoon. Same car. Same price on the windshield. Same down payment. They both sign for a 5-year loan, shake the same hand, and drive off the lot in identical vehicles. One of them will pay about $4,000 more than the other for that same car. Nothing about the car is different. Not the model, not the mileage, not the color. The only different thing is a 3-digit number that neither of them looked at on the way in. One had a 760, the other had a 620. And that gap, the one nobody mentioned during the test drive, is going to quietly follow them for the next 5 years. My name's Victor. I've spent a long time looking at where money actually goes versus where people think it goes. I've spent a long time looking at where money actually goes versus where people think it goes. And of all the silent leaks I've found in ordinary budgets, this one is the strangest. Because it never shows up as a line item. No receipt says credit penalty. No statement breaks it out. You just pay more, everywhere, all the time, and you never see the bill. Today I want to show you that bill, the real one. Add it up across everything you borrow, everything you insure, every deposit you put down, and your credit score isn't a grade you got in some financial class you never signed up for. It's a price tag on your entire future. And most people are walking around wearing one they've never read. By the end, I'll show you the 4 places it's quietly charging you, and the 4th one has nothing to do with borrowing money at all. Most people have no idea it's even happening. Let's read it. Here's the first thing to get straight. Your credit score is not a measure of how good you are with money. People treat it like a character grade, like an A or an F on a report card. It isn't. It's a risk price. A lender looks at your number and translates it into a single question. How likely is this person to stop paying me? And then they charge you accordingly. Higher risk, higher rate. Lower risk, lower rate. That's the whole machine. It's cold, it's automated, and it runs on every loan, every card, and a surprising number of things that aren't loans at all. Now in 2026, the average FICO score in America sits at about 714. It actually slipped a couple of points over the last year, which matters more than it sounds. When the national average drifts down, a lot of people quietly cross a threshold without noticing. They were a 675 last year. They're a 662 now. Nothing felt different. But on the lender's side, they just got moved into a more expensive box, and that's the part that gets me. The system doesn't warn you. There's no alarm when you drop a tear. You find out the next time you borrow when the rate comes back higher than you expected, and you shrug and assume that's just what rates are right now. It isn't just what rates are. It's what rates are for you. So let's stop talking about it in the abstract. Let me show you the 4 places this tax gets collected, starting with the biggest one. If you ever buy a house, this is where the largest single chunk of money changes hands. Not at closing. Over 30 years, take a $300,000 mortgage, which is roughly a normal house in a lot of the country right now. A borrower with a 760 score might land around 7.16%. A borrower with a 620, same house, same loan, might land around 7.82%. That sounds like nothing. 2/3 of 1%. Who cares? Here's who cares. That small gap works out to about $168 more every single month. And you pay it for 360 months. Run the full thing out, and the borrower with the lower score pays roughly $60,000 more in interest over the life of that loan. $60,000. For the same house. The same walls, the same roof, the same kitchen. The difference is a number on a screen that the bank looked at for half a second. I want you to sit with that, because people will spend a weekend driving to 4 stores to save $40 on an appliance for that house and then hand over 60 grand at the closing table without blinking because the credit penalty is invisible. It's buried in the rate. It's spread so thin across so many years that no single payment ever feels wrong. That's the trick. High costs that arrive slowly don't trigger the part of your brain that protects money. A $60,000 mistake delivered as $168 a month feels like nothing. It feels like the price of having a house. But part of that price isn't the house. It's the score. Most people will finance several cars in their life, and the car is where the score gap gets genuinely brutal because car lenders price risk harder than mortgage lenders do. In late 2025, a buyer with super prime credit averaged about 4.66% on a new car. A buyer with deep subprime credit averaged 16.01% on the same car. Stop and look at that spread. Not 1%, not 2%, more than 11 points of interest separating two people buying the identical vehicle off the identical lot. Put real numbers on it. Finance $35,000 over 5 years. At the super prime rate, your monthly payment is comfortable and most of what you pay goes toward the actual car. At the subprime rate, you're paying hundreds more a month, and a huge slice of every payment just evaporates into interest. Over the loan, the subprime buyer can easily pay $8,000 to $10,000 more for the same car. Sometimes the interest alone is worth more than a second car. And cars are where this compounds in a cruel way because the people with the lowest scores are often the people with the least cushion. They need the car to get to work. They can't wait 2 years to fix their credit first. So they take the 16% because the alternative is no job. The system charges the most to the people who can least afford it, and it's all perfectly legal, perfectly automated, and perfectly invisible on the paperwork. Let me make this concrete, because numbers on a screen are easy to wave away. So picture two brothers. I'll call them Daniel and Marcus. Same parents, same neighborhood, similar jobs, similar income, within about $1,000 a year of each other. Daniel checks his credit a few times a year. He keeps his cards mostly paid off, never misses a due date, and didn't open 6 store cards in his 20s. He sits around 770. Marcus never thought about it. He carries a balance most months because everybody does. He missed 2 payments a few years back during a rough stretch, and he opened whatever card gave him a discount at the register. He carries a balance most months because everybody does. He missed 2 payments a few years back during a rough stretch, and he opened whatever card gave him a discount at the register. He sits around 630. Now watch the same 5 years play out. They both buy houses around the same time. Daniel's mortgage costs him less every month, and that gap alone over the life of the loan is tens of thousands of dollars. They both finance a car. Daniel gets the low rate. Marcus pays thousands more for the same vehicle. They both carry a little credit card debt during a tight year. Daniel pays it down at a normal rate. Marcus pays it down at nearly 30%, so his balance barely moves for months. And when they shop for car insurance, Marcus quietly pays more for the same coverage and never finds out why. 5 years in, Daniel isn't smarter than Marcus. He doesn't earn more. He just understood one number, and that number handed him thousands of dollars a year that Marcus paid to banks and insurers without ever seeing it leave. Same life, different price. That's the whole story of this video in 2 people. So let's get into the one that hits monthly, the one most people are actually carrying right now. Credit card interest in 2026 is at brutal levels across the board. The average APR is sitting around 21.5%. New card offers are averaging close to 24%. And those are the averages. Your score decides where on the scale you actually land. If you've got excellent credit, 740 and up, you're looking at maybe 17 to 21%. Good credit, 670 to 739, puts you around 21 to 24. Fair credit, the 580 to 669 range, gets you 24 to 28. And below that, poor credit routinely sees 28% and up, with some subprime cards charging the legal maximum of 36%. Here's why this one is so dangerous. Card interest isn't spread over 30 years like a mortgage. It hits every single month on whatever balance you're carrying, and it compounds. If you carry $6,000 on a card at 24% versus 17%, that gap alone is hundreds of dollars a year going straight to the bank for nothing. Not paying down the balance. Just rent on money you already spent. And there are 13 million credit cards out there issued to subprime borrowers. That's 13 million people paying the highest rates in the system on the product that compounds fastest, often while telling themselves they're handling it. They're not handling it. The rate is handling them. This is the bleed that quietly keeps people stuck. You can be disciplined, you can make every payment on time, and still watch the balance barely move, because a third of what you pay each month is just feeding the interest. The score set that rate. And the rate is why you can't get ahead. Here's where it stops being about loans, and this is the part almost nobody knows. Your credit score gets used in places that have nothing to do with borrowing money. In most states, your auto insurance company uses a credit-based insurance score to help set your premium. Same driving record, same car, same zip code, 2 different scores, 2 different premiums. Lower credit can mean hundreds of dollars more a year on insurance, every year forever, for the same coverage. Renting an apartment? The landlord pulls your score. A weaker number can mean a bigger security deposit, sometimes 2 months instead of 1, money locked away that you don't get to use. Some applicants get rejected outright and have to keep looking, burning time and application fees, setting up utilities, a phone plan, internet. A low score can trigger a deposit there too. Hundreds of dollars held just to turn the lights on. Even some employers run a credit check during hiring for certain roles. Your score, a thing built to predict loan repayment, can sit between you and a job that has nothing to do with loans. None of these show up as a credit penalty. The insurance just costs more. None of these show up as a credit penalty. The insurance just costs more. The deposit is just higher. The application just gets declined. Each one feels like its own separate piece of bad luck. But it's not luck, and it's not separate. It's the same number taxing you in a dozen rooms at once, and because it never announces itself, you never connect the dots. So let's do the thing nobody does. Let's add it up. Take one ordinary person with a fair score instead of a good one. Not terrible. Just fair. Here's their year. A few thousand more in mortgage interest averaged across the life of the loan. A couple thousand more on the car they're financing. Several hundred more a year on credit card interest. A few hundred more on insurance. A higher deposit here, a declined application there. Stack a single year, and you're easily looking at $3,000, $4,000, $5,000 that this person paid more than the higher score version of themselves for the same life. Same house, same car, same coverage, same everything. The only difference is the number. Now run that across a working lifetime. 30, 40 years of paying the fair credit rate instead of the good credit rate on every major thing you finance. You're not talking about thousands anymore. You're talking about a 6-figure tax paid in installments so small and so spread out that you never once felt robbed. And here's the part that should genuinely bother you. Imagine that person had instead invested the difference. Say it's $4,000 a year and it goes into a basic index fund averaging a normal long-run return. Over a few decades, that money doesn't just add up. It compounds into a number with a comma in it that most people would call life-changing. So the real cost of a low score isn't the interest you paid. It's the wealth you never built with the money the interest ate. That's what makes this the most expensive number in your financial life that you've probably never sat down and looked at. It doesn't take from you all at once. It takes a little, everywhere, constantly, for decades. And every dollar it takes is a dollar that could have become real wealth instead of someone else's interest income. Before I show you how to fix it, I have to clear out some bad information because the myths around credit are part of why people stay stuck. Myth 1. Carrying a small balance helps your score. No. Carrying a small balance helps your score. No. It doesn't. This one costs people real money. You do not need to carry debt and pay interest to build credit. You just need to use the card and pay it off. Carrying a balance only helps the bank. Myth 2. Checking my own score hurts it. No. Checking my own score hurts it. No. Checking your own credit is a soft inquiry and does nothing to your number. The only checks that ding you are hard inquiries when you actually apply for new credit. So look at your score as often as you want. Looking is free and harmless. Myth 3. Closing a card I don't use will help. Usually the opposite. Closing a card I don't use will help. Usually the opposite. Closing a card can shrink your total available credit and shorten your credit history, and both of those can push your score down. If a card has no annual fee, the simplest move is often to leave it open and let it sit. Myth 4. I'm too far gone, it'll take a decade. Rarely true. I'm too far gone, it'll take a decade. Rarely true. Utilization updates monthly, so the biggest lever you have can move your score in weeks, not years. People talk about credit like it's a permanent sentence. For most folks, it's a dial, and the dial moves faster than they think once they stop believing the myths. Clear those 4 out of your head, and the actual fix gets a lot simpler. Because here's the good news, and it's genuinely good. You don't need a perfect score to stop most of this bleeding. You need to clear the right cliffs. Credit pricing isn't a smooth line. It's a staircase. The cost doesn't drop a little for every point you gain. It drops a lot when you cross certain thresholds, and barely at all in between. So the goal isn't 850. The goal is to get over the next step. The big ones to know. Around 620 is where a lot of doors open from denied to approved, but expensive. Around 670 is where you cross from fair into good and a real chunk of the penalty comes off. Around 620 is where a lot of doors open from denied to approved, but expensive. Around 670 is where you cross from fair into good, and a real chunk of the penalty comes off. Around 740, sometimes 760, is where you reach the best pricing most lenders offer, and climbing higher than that buys you almost nothing. What this means is powerful. If you're sitting at 650, you do not need to obsess about reaching 800. You need 20 points to clear 670. That 20-point move, which a focused person can do in a few months, can be worth more than every coupon you'll clip for the rest of your life. The staircase is where the money is. So how do you climb a step? Let me cut through the noise because most credit advice is either useless or backwards. The single biggest lever you control is utilization. That's how much of your available credit you're using. If you've got a $10,000 limit and you're carrying $5,000, you're at 50%, and that hammers your score. Get it under 30%, and ideally under 10%, and the number can jump fast. This is the one that moves quickest, sometimes within a single billing cycle, because it updates every month. A practical trick most people don't know. You can pay your card down before the statement closes, not just before the due date. The balance reported to the bureaus is usually the statement balance. Pay it down early, and a smaller number gets reported, and your utilization looks better without you doing anything different. The second lever is payment history, and this one is brutal but simple. One missed payment can drop a good score by a lot and sit on your report for years. So if you do nothing else, automate your minimums so a payment never slips through. On time, every time, is the foundation everything else sits on. Third, leave your old accounts open. The age of your credit matters, and people sabotage themselves by closing the first card they ever got. That old account is doing quiet work just by existing. Let it. Fourth, be careful with new applications. Every hard inquiry nicks your score a little, and several in a short window look desperate to a lender. Apply with intention, not out of boredom or because a store offered you 10% off at the register. And last, check your actual report, not just the score. A real chunk of credit reports contain errors. An account that isn't yours, a payment marked late that wasn't, a wrong balance. You're legally entitled to dispute these, and getting one bad mark removed can move your number more than months of perfect behavior. The score is built on the report. Fix the report. I want to go back to those two brothers because I think the lesson is bigger than any single loan. Marcus wasn't a worse person than Daniel. He wasn't lazy or stupid. He just never understood that the number was a price and that the price was negotiable not by haggling but by moving the number itself in the months before he ever needed it. That's the shift I want you to leave with. Stop thinking about your credit score as a grade you passively receive. Start thinking about it as a rate you actively set. Because every point you climb gets quietly refunded to you across every loan, every card, every premium, every deposit, for the rest of your life. Most people will go their whole lives paying the invisible tax and never once look at the bill. You just looked at it. That alone puts you ahead of nearly everyone, because you can't fix a leak you can't see, and now you can see this one clearly. So here's what I'd do this week. Pull your real score and your real report. Find out which step of the staircase you're on and how far you are from the next one. Knock your utilization down before your next statement closes. Set every payment to automatic. And then watch the number move, knowing that every point it climbs is money walking back into your pocket instead of someone else's. Your credit score was never a grade. It's a price tag. Go change the price. I'm Victor. If this changed how you see that number, you know what to do. I'll see you in the next one.